Another video today. Today's video is hard money, hard money, hard money. Today's video is on hard money. People like to think that hard money and private money are the same. Sometimes hard money lenders can be private, but they're not always the same. I'm not really here to talk about the differences today, but I'm just here to talk about hard money. I'll do another video on private money, but here teaching you guys how to build wealth through real estate and, dropping these gems for you guys. As I learned through real estate, I always like to share with you guys, as I'm a broker here in the Kansas City area, and I invest as well, help people buy and sell property, work with a lot of out-of-state investors, in-state investors, but that's a little bit about me. I'm here today, though, to help you guys learn, like I said, about building wealth through real estate. If you watch my channel, that's what I'm here for. That's what I do. I try to share information on real estate, but you can learn something in real estate every day. So I'm here to help and teach you guys how to build wealth through real estate. It's widely talked about. A lot of people like to talk about other people's money, and sometimes people are like, what is that? What is other people's money? It's private money and hard money. So today we're on hard money, and what it is, it's a loan, folks. Hard money is a loan just like any other loan that's out there, but it's a little different, and sometimes they could be considered as a non-QM, non-conventional mortgage, or non-qualifying mortgage. I don't know. People have thrown all types of terms and names and acronyms on them. Oh, can I get a DSCR loan? There's all types of different terms out here. Be careful. Stay in the know. I will put some terms and the definitions and things like that so you guys know what they mean, what they stand for in the, box below, in the suggestions in the comments. So you can kind of differentiate. But today specifically, we're just talking about hard money loans from hard money lenders. We're not talking about the private stuff, okay? So hard money loan is an asset-based loan. They typically lend off of the asset, that asset's performance, what that asset is going to bring in as far as income, and they will look at that and they will say, okay, we will lend you money based off of what you say you're going to do, based off of the projections of this asset, and these are our terms, here are our rates, pretty much take it or leave it, here's the terms. It's kind of the same thing when you deal with another, typical mortgage broker or lender. They're going to give you the information, they're going to give you the requirements, and they're going to come back and they're going to say, hey, this is the rate I can give you, this is the terms, and it's kind of the same thing, right? So that's in a nutshell. That is the basics of hard money. And I'm going to give you the positives. So if you keep watching, watch to the end, continue to watch the video, these gems that I'm going to drop when it comes to this hard money. And, the only negative is that it's a little bit more expensive than the typical loan, say if you went to the mortgage broker or the bank. So it is a little bit more expensive, but that's the only bad side. I mean, as far as I see it, looking at it when it comes to people just giving you free money or giving you loans. I'm not going to say that it can't be anything bad that goes wrong or happens with a hard money lender, but I'm saying as far as the positives and the negatives when it comes to going to a mortgage broker or, needing all this certain criteria and things like that, trying to get a loan, okay? But once again, like I said, it's secured, the loan is secured by the asset, the property that's being bought. That's how the loan is secured, pretty much, by the property that's being bought. Usually they're short term, usually they're like 6 months to 9 months, 12 months. They can go up to, 2 to 3, 4 years, but usually it's a short term basis, okay? So it's different than the mortgage loan when you're getting a 30-year note or a 5-10-year ARM, something like that. It's different. It's the total strictly usually for a short-term basis. They know that you're either going to sell the property or they know you're going to refinance out of that property at a certain time period to get into another loan. I'll explain that later. But for the basis of this, hey, that's what it is. They're going to give you a loan. They're going to say, hey, it's going to be 10% interest, 6 months, is the time frame. If you go over that 6 months, we may charge you an extension fee. So, but we'll give you another 6 months if you need it with that extension fee, another couple grand or whatever that may be to let you extend it. Say if something does happen. But for the most part, 6 to 12 months. That's what they're going to give you. But yep, they got their fees. They're going to give you an extension. Oh, well, we're going to charge you an extra 2-3 grand because hey, you went over the 6 months. But it's going to be 10%. It's going to be interest only. So when they give you these loans too, it's not like, hey, you're paying principal, you're paying interest, and you don't even pay interest until, halfway through the loan and nothing like, no, because you're paying principal up front. None of that. It's interest only. So they'll give you a 10%, 11% is what the going rate is right around now. Some can give you 9%, but it's interest only on your money. So, they give you that loan, say you need one of $100,000, they're going to charge you 10%. You do the math. Like, that's it. And that's the cost of doing business. They give you the 100 grand. All they ask for you is to give them that extra little 10 grand on the backside, of that 10%. So make sure you give them their 10 grand. So you got to give them that 100. That's it. That's it in a nutshell. That's kind of how it works. But they're mainly for investors. So a lot of people use it as an entry point to get into real estate when they don't have the capital themselves, or when they don't have the best credit themselves, or maybe you're just sweet or awesome at finding a deal. You can go find dope deals, but you don't have no money in the bank. You ain't got, So they're like, well, hey, how about I go reach out to a hard money lender? The hard money lender is going to look at that property. You give them the property. You give them how much it's going to cost to buy it. You give them how much it's going to cost to fix it up. And then you give them how much it's going to cost to sell it, or how much it's going to be worth at the end as far as an appraisal on the back end. They're going to look at those numbers, and then they're going to say yes or no. And they're going to say, hey, this is a deal. We will lend you the money. Here's the terms. Or they're going to say, nah, maybe we need to adjust this a little bit. Or maybe we don't like that area, so we're not going to lend in that area. Here's another hard money lender or somebody that does invest in that area. We kind of stay away from that area. It's private. These hard money lenders, they can do what they want. It's their money. Sometimes they're investors themselves. Most of the time they're investors themselves that just have capital. They just want to sit back. They just want their money to work for them. So they lend money out, just like a private money lender. They just want to lend money out so their money is working for them. Smart, right? Once you get money and start accumulating, you can do the same thing. But that's what they do. So they'll lend their money out at 10%, 15%. And they know that, hey, I'm about to make $5,000 on my money. I'm about to make another $10,000 on my money. Or I'm about to make $20,000 on my money because I just lent out to a stranger. But they got a process and it's vetted, things like that. But that's how they make their money. It's brokered sometimes in between, but that's how they make their money. These hard money lenders is by lending money out all day. That's their business. That's what they want to do. So that's another benefit is they want to lend money to you. What is it? What option is that? They want to lend money to you. Yeah, the banks, they want to lend you money, but they also want to make money off of you too. They want to lend it to you, but they're going to lend it to you, and then they're going to say, nah, they're going to give you all these strict requirements, and they're going to hit you over the head, say, oh, no, well, you got to do this, you got to do that. Oh, you got to go to our underwriter, you got to do that. Hard money. You ain't got to do that. No, you just show up, show the numbers, bring the deal. You bring the deal, they give you the money, bam. There you go. Now, I'm not going to say you won't have to put money down, because sometimes you'll have to put money down for the closing costs. Is like a typical loan. They want you to have skin in the game. They're not just going to give it to you. So you do have to put skin in the game, have a little bit of money to put down. Like 3% or something, kind of like an FHA loan. Hey, you put down 3%, dude, we'll give you all the rest. Just put some skin in the game. Or they want you to put that first draw down, or sometimes both. Draw, that's something else. That's the construction money that they're giving you as you're rehabbing the property. They give it to you in draws. It'd be like first draw, second, third, fourth draw. Because they're not going to give it all to you in a lump sum. They want to protect their money, right? So they give it to you over periods. Timeline is pretty much when you get your stuff done. So say you got the kitchen done, or well, let's start at the beginning. The demo. Demolition, they'll give you the first draw. Or the first draw you got to pay out of your pocket with demo. Bam. They want to verify. Some people are different. Sometimes they send out an inspector, just some person they send out there just to verify it, that the demolition's been done. Or they might trust you and say, oh, no, just send me a picture. Or here's my app. Send me a photo. Send me that photo. Oh, okay, bam. I see you did the demolition. Now we're about to cut you $5 grand to do the floors. Do the floors. Same process comes back. The guy comes back, inspects it, or they send you the app. You take the picture. Bam. Yep, you did the floors. Cool beans. All right, now we'll give you the money to do the duct work or an AC unit. We'll cut that check. Bam. So that's how it goes in cycles. The bathroom. Oh, you want to do that? Bam. Now we'll cut that draw. That's how it goes. It's called in draws. So you always want to check draw fees. Some people charge you for each draw. Some people don't. Some just say, hey, here's just a draw. Check and ask questions. Because if there's a draw fee, you might want to get more work done so you can have less draws. You see what I'm saying? You get more work done and you have 2, 3 draws instead of 5, 6 draws because they're hitting you over the head with a draw fee every time you're drawing, right? So the more, trustworthy you get, the less fees you might have, the better interest rate you may get, the more deals you do with that company or that lender, they'll give you cheaper rates. They're like, oh, dude, you've done 2, 3, or 4 of these. Man, oh, I know you're good. Oh, we'll give you the lump sum. Then they might not even give you draws. They're going to say, oh, we'll just give it to you in 1, 2 draws. Bam. I know you're good for it. We've done 6 deals. You haven't burnt this yet. Or if you've done 3, you haven't burnt this yet. Instead of 10%, now we're going to give you an 8%. It's the relationship, and it's the beautiful thing of real estate, and it's the beautiful thing of hard money. Same thing with private money. If you're dealing with a hard money lender or a private money lender, and say you do 2, 3 deals, and they don't try to reduce their rates for their relationship with you, kick them to the curb. You're like, dude, I'm doing 3, 4 deals a year. Give me a little cheaper rate so I can keep doing these deals. If they're not willing to do that, kick rocks, because somebody is, because they're going to realize the value that you bring them. They're sitting back and you bringing them their money, 10 to 15% back every time. Like, who don't want to do that all day that they can trust? So that's what they do. And that's why I said it's a hard money loan. That's why it's advantageous to people to get these loans. That's the advantage. I bought my first property, not my first home, but my first investment property, hard money loan. And it's a learning curve when you do it. But take notes. I advise you to take notes, see what happens, go through the process, and ask as many questions as possible. Also, another question to ask, how do they go about it if you default on the loan? Because it happens. Say you're trying to flip a property, something goes sour or whatever. Ask them, do they go after you or do they just go after the asset? The good ones are going to be like, yeah, I'm just going to go after the asset. Those are the ones you want. Because then they're not even going after you. So you can default on the loan. They're not even going to go after you. They're just like, no, give my property back. They just take the property and go sell it. They'll put a lien on that thing. And I'm not saying that they won't go after you, but ask. A lot of these people, they don't ask these questions. Ask questions. And they're going to be happy to answer them for you. If they're not answering these questions, something's wrong. Go find you somebody else. But they'll tell you, they'll say, oh, no, we go after the asset. Or they're going to say, no, we're going to go after you, so make sure you're good. Those are the ones you want to stay after because you don't want nobody trying to go after you because you're trying to go learn this real estate thing and maybe a mistake may popped up and now you're underwater and you're going to have to sell this property or, push come to shove. Worst case scenario. But if that's the case, yeah, you want them to go after the asset, not you. That's another gem, okay? Ask that question. Ask about points. There is points. Sometimes people are like, oh, well, you got to pay 2 points. But like, what the heck is a point? A point is a percentage that you're going to have to pay to get a cheaper rate or to get that deal. It's usually a percentage like 1%, 2%. 2% will be 2 points. 1% will be 1 point on top of that loan. So, usually so that's a point is $1,000. If it's $100,000 loan, that 1 point would be $1,000. 2 points, $2,000. That makes sense. But there's a lot of terms that you guys need to know and get familiar with as well when you're going through this process so you don't get burned and don't get stinged and so you know what's going on. So that's why I'm here to try to help you guys. So there will be some terms and things like that in the description as well, going over those in the definition so you know what they are, get familiar with them. But yep, and some of these terms, like I said, you just need to know them because they're going to be throwing them out, spitting them out at you. You need to know what they are. They'll say like, oh, LTV. What's LTV? Loan to value. So let me give you some of these terms. Loan to value. You need to learn what loan to value is. I just said points. You need to learn what points are. You need to learn, what those things mean. Interest rates, obviously, you need to learn what an interest rate is. And then the down payment. You need to learn, about the down payments these hard money lenders require. So you need to learn some of these things. Loan to value means how much money they're going to loan you on the back end on that property. Say you're trying to do a cash out refinance, which is what a lot of people want to do, right? So they're going to give you a loan to value of 70%, 75%. You want ones that's going to give you 80, 85, 90%. But the basics, most of the time it's 70 to 75%. They're going to give you a loan to value on that money. And that's pretty much based off of the ARV, the after repair value, and it's based off of the equity that you have. And then they're going to give you a loan to value 70 to 80% of that equity that you have in that property. Okay, that's what they're going to give back to you as say a cash out refi, or say the loan to value. That's how much money we're going to loan you. So say if they're going to say, well, we only loan the properties that's $150,000. Okay, so the property's worth $220,000, right? We're going to give you 70% loan to value, or whatever the case that may be. That means we'll give you a loan for $150,000, right? So you can pay off that hard money lender. And that's what you're going to refi back with, because that's what the home is worth. So then you can walk away with a check for that difference, 10, 15 grand, 20 grand. Woo! Did I just sneak the burr in there method on you? That's the burr method. I got another video for that too. I can drop that in the suggestion, in the box as well below in the comments. But that's the burr strategy. Don't let me get off topic. But that's how people are doing these things when it comes to hard money. They're using hard money, refinancing on the backside, pulling the cash out, whatever money that they put down into the deal or for the down payment, then they're taking that money out. Bam, let me go find another property, another deal. I'm going to go do it again. Did you hear me? I'm going to go do it again. Say I put 8 to 10 grand in this property. I'm pulling 8 to 10 grand right back out. Oh, the money I just put in and bought for this property, I'm about to go do it again. Say you put $70,000 into this property and you get 50 of it back. Woo! Just because you had such a sweet deal. You're like, dang, I just got this brand new property that's been remodeled and I'm only in it for like 20 grand. And now it's cash flowing asset for me. I'm going to give you my deal and show you guys what I did on my first one, and you're going to be like, what? Or even what I could have did. I mean, it's just real estate thing is crazy. And that's why I love it. That's why I'm passionate about it. And that's why I'm trying to teach it to you guys, because it can get ridiculous the way this thing starts to snowball. Like I said, you get one property, then you do it again, 2. Next thing you know, it's 3. And before you know it, you look up at the end of the year and you done got 4 properties. I've seen it happen. I see it happen all the time. I see stories. I hear stories all the time of people that started out and then in 5 years they got 12 properties underneath their belt, cash flowing $2,500 a month or $3 grand a month, and they're essentially retired because they got $3 grand every month coming in off of rental properties. So that's why I want to teach you guys about all this stuff and this hard money stuff. Please dive in and just take notes and ask me for questions. If you guys have any questions, you can always reach out, DM me, comment. You can always call, whatever. Shoot me a text. I'm here for you guys. But yeah, I just want you guys to know, because I'm passionate about this stuff, man. And it's just ridiculous of all the knowledge that's out here that people don't know. And they're sitting on the fence and they're hurting. Maybe the situation's bad. And real estate might be the thing that can get you over that hump. It might be the thing that gets you out of that paycheck to paycheck lifestyle. I'm not trying to tell you to quit your job. I'm just telling you to use that job to invest in real estate, folks. That's all I'm trying to tell you to do. Buy your first home if you haven't done anything yet. That's all I'm trying to tell you to do. I mean, at the end of the day, that's all I'm trying to do. I'm just trying to educate you guys and give you guys a little bit of information that, hey, you guys can win in this too. There's a lot of big fishes out there, but there's a lot of small fish out here that's still eating. And they still swimming. I'm going to tell you that right now when you get out here. So, some more, advantages of hard money. Back to the topic. These advantages that they have. You don't have to have no 700 credit score. The tax, receipts and, you need your tax returns. And they don't scrutinize you like that with hard money loan. That's another advantage of it. That's why people are doing it. That's why I'm trying to tell you guys to look into it. All they're going to ask you for, they might say, hey, we're going to run your credit score. You need to be at least like a 550 or something, But they're not going to ask for the last 2 year tax returns. I need the last 4 bank statements. I need, they're not going that far. They just want to know the parameters of the deal on the asset that you're trying to buy, what you're looking to do with it. And then they're going to say, okay, you got a credit score of 580. All right, you're decent. You got a little bit of money in the bank to put down. Cool, let's go. Okay? But that's another advantage is you're not as scrutinized as you are with an FHA or a conventional loan, a typical mortgage broker. You're not as scrutinized. Like I said, it's based off the asset that you're purchasing. Okay? Like I said, I'm not going to say that they will require a credit score, but it's not going to be a 700. It's just, if you want to do that, you can go get a conventional loan. You got a 700. That qualifying criteria, that's a deal breaker right there. The qualifying criteria for, getting into one of these loans, that is a deal breaker. And for most people, when they're trying to buy a home, is the criteria, the credit score, the debt to income ratio, my tax returns, my job history. That's the stuff that gets people out of buying homes and buying property. The criteria that they want. So when it's less stringent, why wouldn't you go and use that route? You might be on the market with 6.5%, 7%. And, they're going to run you through the ringer. You got to have the 680. You got to have, But on this hand, you're not going to have that. Yeah, you're going to pay a little bit more. It might be 8 to 10%. But then again, it's also interest only. So these are all advantages and these are all positives. To why I say you should look into hard money and don't be afraid of it. I got people, I don't want no hard money. Hey, use it to your advantage. It's all about how you use it. But use it to your advantage. Don't be scared of this stuff. FHA loans, hard money loans, private lenders, DSCR loan. Use them. If you can, use them to your advantage. Just use it wisely. That's what they're here for. They're here for people like you to help get you out of your situation and get you into a home or get you into an investment so you can start generating wealth for yourself. You got questions, reach out. I'm here for you. Okay? But that's what these loans, that's what these options are here for. They're here for you. Advantage of it. I mean, yeah, obviously the down payment might be a little bit higher, the interest rate may be a little bit higher, but you're not scrutinized and you're getting in the door at the end of the day, folks, right? Ain't that what you want to do is get in the door? I try to teach people this and I tell, hey, at least you're getting in the door. Well, I don't want to pay 10%. I get it. But at least you're getting in the door and you're sitting off, you're getting in the game. You're getting off the sidelines. Because that's all you're doing is refinancing out of that 10%. Look at the 10% as a 6-month to 12-month time frame to let me get in the door, get in the game. I'm going to refinance out of it. Then I'm going to get my 6%, 7% on my 30-year note and I'm good. Or I'm just going to sell the property, buy it, fix it, sell it, make my profit, and then give them back their little 10 grand or whatever that you owe them. And then you're making 20 grand. Who cares if you got to pay them 10 if you're making 30? I'll pay somebody 10 grand if you're going to let me make 30 all day. I'm making 20 grand, you're making 10. And this is just on the low aspect of flipping. You can make 50. Say you buy a flip, you got the right property because you're just awesome at finding, you're dope at finding these deals. You make 60 grand and you're paying them back 15 grand. I'm there all day, right? And you did this in a, 6-month period of time frame. You made 60 grand in 6 months. The average flip sometimes only takes 3. But that's people that are seasoned. But say you made that in 3 months. Why not use it? Why not take advantage of it? Come on now. It's just time to get in the game, folks. Time to get off the sidelines. And it's just time to use this knowledge and these advantages that they are giving you. MDHC, KDHC, those are down payment programs. FHA, hard money, private money. All options. Get in the game. It's like EA Sports. Get in the game. Because you got options. And I'm here to give them to you. So, yes, get in the game. I could go over more advantages, when it comes to this hard money loan. Because, like I said, they're going to give you money to buy a property, fix it up, rehab it, and then sell it. You try to do that with any other product on the market. You say you got a conventional loan or something and you're trying to fix up. It's rough. Do that with a 203K loan and get it and then try to go through the draws and the construction and Way easier than doing it this way because they're not running you through the ringer. They're giving you the money to buy a property, fix it up, and rehab it. Then you can sell it or refinance and keep it. Those are the options, folks. And it's like, why not take advantage of it? Okay? So I'm trying to give you the pluses. Yeah, I'll give you the minuses too. But these are all advantages, what I see. I see green. I'm like, ooh, take advantage of these options, folks. They're here for you. Okay? But that's my spiel on hard money. If you guys got any more questions or need anything, reach out. As I always say, people, stay safe. Stay blessed. Peace.